We begin with the fourth chapter of the course. In this chapter, we will talk about fundamental analysis in order to have criteria and tools to choose which stocks to invest in over the long term. Fundamental analysis is a valuation method that studies the financial parameters of the companies where we intend to invest. The aim of fundamental analysis is to determine the intrinsic value of the company and compare it to its market value. This method is based on the principle that over the long term, the company's value will converge to its intrinsic value. This analysis is used for strategies of long-term investment. By comparing the intrinsic value of the company with its market value, we will have two situations. The first one is when the intrinsic value of the company is greater than its market value. In this case, the company is undervalued, and therefore the stock price should rise over the long term. When the intrinsic value is less than the market value, the company is overvalued, and therefore the stock price should fall over the long term. The market value of a company is equal to the stock price multiplied by the number of existing shares. On the other hand, in order to determine the intrinsic value, we can use some of the following valuation methods. One of them is the discounted cash flow valuation method, whose acronym is DCF. The intrinsic value of the company is the present value of the expected cash flows. Here's the equation used to obtain the intrinsic value of the company. In this formula, IV is the intrinsic value of the company. CF of T is the cash flow in the period T. R is the discount rate, and T is the lifetime of the company. The other valuation method is known as relative valuation. In this case, we determine whether the company is undervalued or overvalued by comparing various financial parameters of the company with those of its competitors. This method is the most used. Let's see in more detail the relative valuation. As previously said, this method consists of comparing various ratios and financial parameters of the company with those of its competitors. And one of these ratios is the one known as earnings per share, whose acronym is EPS. It represents the net profit of the company per each existing stock share. It is a great indicator of the company's profitability. The EPS can be quarterly or annual. If it is annual, we can have three variants. The last fiscal year EPS, the one known as trailing EPS, and the one known as forward EPS. The first one, the last fiscal year EPS, is calculated by using the profits produced by the company over the last fiscal year. On the other hand, the trailing EPS is calculated by using the profits produced by the company over the last 12 months. And the forward EPS is calculated by using the forecasted profits for the next 12 months. If the current quarterly EPS is greater than the one of the same quarter of last year, it is a good sign for a bullish position. It is the same for annual EPS. Another very important ratio to analyze is the one known as price-earnings ratio. It is the ratio between the current stock price, that is, the current market price, and the earnings per share of the company. So, the price-earnings ratio is calculated as the current stock price divided by the earnings per share. To calculate the price-earnings ratio, the trailing EPS is commonly used, so the ratio obtained is the trailing price earnings. For example, if the stock price is $300 and the trailing EPS of the company is $30 per share, then the price-earnings ratio for the stock is 10. The lower the price-earnings ratio, the better, because these companies tend to rise faster than those with a higher price earnings. Every industry has its own price-earnings ratio. Therefore, if we pick a stock for a bullish position in a particular industry, the best is that the price earnings of the stock is less than the price earnings of the industry. Another parameter, very important to analyze, is called return on equity, whose acronym is ROE. The return on equity measures the company's ability to generate profits with the shareholders' equity. It is a great indicator of the company's profitability. The return on equity is calculated as the net income divided by the shareholders' equity. For example, a return on equity of 30% indicates that a $30 profit is generated for every $100 invested. In the case of going long, a return on equity above 12% is a good sign. In contrast, a return on equity below 10% is a good indicator for a bearish position. Finally, we will see two more parameters. The first one is the one called float, which is the number of shares available for public trading. The float and the shares held by the company's managers and directors are the outstanding shares. They are all existing shares of the stock. In general, the larger the float of a company, the less volatile the stock price will be. On the other hand, we also have what are known as upgrades and downgrades. Financial analysts place recommendations on companies depending on their financial statements. When there is a positive change in the ratings of the stock, that is, an upgrade, the price tends to rise. In contrast, when the change in the rating is negative, that is, there is a downgrade, the stock price tends to fall. Here's an example for the Apple Company of some of the previously seen parameters. Notice that we can see the trailing price earnings, whose value is 14.93, the trailing EPS of $25.28 per share, the return on equity of 41.99%, which means that almost a $42 profit is generated for every $100 invested, and the float, that is, the number of shares available for public trading. Whether we invest using technical analysis or fundamental analysis, to make a decision, we can use both methods in order to complement each other. For example, the fundamental analysis can be used to choose which stock to invest in, and the technical analysis can be used to decide when to buy and when to sell. Here we ended with the chapter of fundamental analysis. In the next chapter, number 5, we will analyze the financial instruments known as penny stocks.